All right. So hopefully, all right. So what I'm going to talk about today. All right, we're in. Okay. Yeah, we got our 3 screens. Okay. All right. So the first thing I'd like to look at today is the S&P 500 chart. We're basically at a level that we were. I mean, we're basically at the top of our range of our downward channel exactly at this point. And this is the same with a lot of our other stocks and indexes we're following. Let's look at, okay. Let's look at the stochastics for each one of the stocks we're following. There they are, right here. Okay, so you can see the S&P, we're at the top, absolute, hit a penny at the top of this range. If you connect the dots for the tops of the S&P, we're basically at a top, and they're in a downtrend. So we're going to have to we need something to get us out of this downward trending. Otherwise, we're going to be right here next month. Right now, we have seasonality on our side. Seasonality meaning every website that you go to is saying, seasonality-wise, we're in a good time of the year because there's a lot of buying that happens in the last part of the year. In the last, when we look at our chart for, let's look at our chart for, there it is right here. Wait, right there. Average monthly stock market returns. The last 3 months of the year are typically the best. So we're expecting good things out of December. And we had, the stock market's been up this week, 1.5%. So that doesn't mean this is 100%. If this was 100%, everyone here would be millionaires. But it's a tendency that people get excited around the holidays. And there's a lot of seasonality buying, like pension funds need funded, etc. We don't know all that happens behind the scenes, but when we go to Yahoo Finance, we're going to see Yahoo Finance. There it is. When we go to Yahoo Finance, it'll basically say the same thing almost. Let's look. We're waiting. Okay, so actually the stock market just closed today because it is a shortened day of trading. It's a holiday. It's considered like a holiday, day after Thanksgiving. And okay, so you see some of the see. Okay, but there is a tendency at this time of the year to have positive stock market returns. Okay, so, all right, so basically it was flat, didn't really move a whole lot. There's a very small amount of trading going on in a shortened session. So just the volume was very light. So even if it went up a lot or down a lot today, you just can't take it too seriously because all the traders are on vacation right now. So let's look at some of the top performers in the stock market today. We have Kroger, Universal Health, Mosaic, DaVita. Okay, we have a lot of healthcare companies. Let's say we have Universal Health, DaVita, they're a diabetes company, Molina Healthcare. Okay, so these are conservative sectors that pay dividends. Kroger, these are food companies, pay dividends. So whenever there's high inflation, Kroger can raise their prices and do well in that environment. The ones that went down the most, Activision went down. They were in a agreement. Microsoft tried to take them over, but there could be an antitrust that will block that sale. So whenever this went up on that news, that is giving some of that back right now because it might not happen because of antitrust. You see, what else is a common thread here? These are all different. All different. There's nothing in common really. Apple is going down today because there are stories that it cannot make as many iPhones as it needs because of lockdowns in China. Their main factory is being affected by the COVID outbreak, and there are disenchanted employees. So they might not be able to make the number of iPhones they need for this Christmas holiday season, which is bad, but they'll make that up most likely. If they don't sell enough now, they'll probably wait for, and they'll get all those sales in the next 3 months, because that's the way it is with Apple, because you have a lot of 99% of Apple users continue to use Apple and won't go to another system. So they delay a purchase instead of getting an Android instead. So that's kind of why it isn't down more on this news that they can't produce enough iPhones. Other things to mention, nothing interesting. But this is a very conservative. Stocks that are going up right now, it looks like the stock market is kind of in this small volume session. The stock market's kind of preparing for a recession, because the stocks that'll do better in a recession are ones such as the drug companies like Gilead. You have energy doing well, and U.S.-based companies. That's another theme here. Okay, now the top decliners are the high multiple stocks. These are stocks with high PE ratios. You have JD.com, Baidu. These are all Chinese stocks. So JD, Baidu, and high PE stocks, most of them. And what else can we say about this? Semiconductor stocks. Lam Research, Applied Materials. Okay, so AMD. So these are high multiple, and they're semiconductors. They're out of favor right now. Let's look at what the Dow is happening in the Dow. These are more conservative stocks that pay dividends, the ones that are going up. Walmart, these are all ones that will do well in a recessionary environment. Home Depot is sold off, and they've reported good earnings recently. So it seems like these are all stocks that are paying a dividend, are conservative. The ones that are doing the worst are higher PEs, higher PEG ratios. So, but we can't really take this. We have to take it with a grain of salt, because it was a shortened day and it wasn't a whole lot of volume. Okay, so let's look at what else we're going to look at today. Yeah, Microsoft likely faces FTC antitrust investigation. So that's why Activision went down. And let's see, what other news stories can we look at? Okay, so here's another irresponsible comment by Kathy Wood. Last year or 2 years ago, we were talking about Kathy Wood Is she a zero or a hero? And back then we said a zero. And now she's hyping cryptocurrency. She is buying Coinbase, which is a cryptocurrency company, the exchange. Even when it's down 80% or whatever, she's buying more of it, and says Bitcoin is going to 1 million, which is totally irresponsible. So she is out of touch with reality, and I think right now her ARK funds are down 80% or something. So I'm not sure. We'll keep our eyes on this, but I think it's and having companies like CNBC cover this cryptocurrencies is very irresponsible. Everyone involved, because it's a scam. Let's look at other things that are happening here. Okay, it's always good. Yahoo Finance is the best place for news stories, and I always go here for, the most important stories of the day. And let's see. Okay, that's all we can get from this. Okay, so now let's go to our talking points. Talking points are, okay, you can see where for every one of these, we're looking right now at the ETFs, the major ETFs of the stock market. And whenever we're putting together a portfolio or we're buying and selling stocks, we try to get an equal balance for these kind of sectors, so that whenever one sector goes up, the other sectors will make up for it when they're down, etc. So you have to have a little bit of every type of portfolio, every type of sector in your portfolio for a well-diversified portfolio. You can see most of the indexes are overbought, and they're at the top of their range. So what does that mean? We could break. We don't see a breakout yet. You'll see if we go up 5% next week, you'll see it break out of that channel. Otherwise, if we start going down, we're going to be in this downward channel still until we get out of it. So look at every one of these sectors. The QQQ, that's the technology. Another XLK, overbought and at the top of the range. Same with XLK. We're at XLY now. The same pattern. We're almost at the top of the range, and we're overbought going down. XLB is the material sector. It's actually going sideways, so it's overbought and near the top of its range. Communication sector is just abysmal. This is the worst chart of the whole stock market. All the telecom stocks are going down because basically T-Mobile is eating their lunch. So Verizon and AT&T, which make up a good portion of this sector, their charts look exactly like this. Healthcare is it's a conservative sector, and it's actually doing well today. It's at the top of its range, but it's basically range bound. It pays a dividend. Every every index we're following is pretty much at the top of its established range. XLI, very similar to the S&P, or to utilities or dividend stocks. Consumer staples, it's at the top of a range. Looks like for a lot of these sectors, the next step is down here, unless there is some major activity that will allow us to break out of this, such as a news with interest rates or good earnings. Earnings don't come out for 3 more months again, so we have to wait a long time for that. Okay, so the financial sector, same as the S&P. Utilities, that's a sector that's going its own way right now. It's going sideways. It's halfway between the channel and it's overbought. All right, so real estate, same as the S&P basically. And the energy sector is still in an uptrend. So let's go the XLE. Let's say it's at the top of its range, and we have the price of oil going down now. So the very, very, very good chance the next stop where XLE is down here, and a zigzag pattern up. Okay, stochastics for stocks. We noticed that a lot of stocks we're following, I mean, a good portion of stocks are starting to break out of their downward. We have a couple of stocks that are breaking out of the downward channels. One of them, and this might be just a blip, like it was right here, but if there's a new pattern possibly going up for this one, Abbott Laboratories. Let's see another one like that. Okay, here's Procter & Gamble. You can see it just barely starting to break out. Let's look at one more. I know this one. Oh. Okay, Amgen. This is an example of stock was sideways for quite a while, and now it's developing an uptrend, very similar to XLE, the energy stock, and T-Mobile. It's starting a higher high, higher low. And the reason we're following these charts is as soon as one of these breaks out, eventually we're going to see a pattern where, every stock breaks out, and then we're collectively going to turn this downtrend into, a stocks going over their 200-day moving averages, and that'll indicate when we're turning. But it takes just one stock at a time to break out of its channel. Walmart is in an uptrend. You can see it's making higher highs, higher lows at the top of its range right now. A lot of stocks are in the top of the range, so it's a very good indication we're going to have a pullback. So let's look at our stock market calendar. So we're on the 25th. So this is Thanksgiving, and we were expecting a good week because of shortened holiday season, shortened holiday today, and we had a holiday for Thanksgiving. So we were up 1.5% this week, and seeing that almost everything we're following right now is overbought, there's a very good chance that we're going to pull back in the next week or two. We're going to have a Fed minutes on the 15th. And so people are going to be really cautious going into that. So you're going to have, some consolidation of all these gains we've had, most likely. And depending on what the Fed says, we're going to raise it maybe 50 basis points and go up or stay where we're at. Whatever they say is going to be watched very closely, and that'll determine basically where the stock market goes after that. So, and then we expect an end of the year rally because typically the rally happens between the 27th and 31st. Not necessarily 21st to 24th, but one of our rules is that the stock market does well before holidays. So we're guessing 21st to the end of the year is probably going to be good. And it actually, the seasonality extends usually till the 4th, the day after the first of the year. So after that, we have no earnings reports, for a while, and then we start having earnings reports at the end of January. All right, so then we have the Fed meeting again in February. We have to wait 2 months for the Fed to meet. There's nothing in January for the Fed. And we're hoping by the middle of February, there's going to be some finality with interest rates, good riddance. And a lot of major companies are saying this is unknown until like May, and then May things will pretty much get back to a normal stock market. That's why it's all yellow right now. Okay, so that's the let's look at some of the big pictures for the stock market. S&P is up 1.5% in the last week, and right now both the 2-year and 10-year are unchanged. But the big problem with the treasury rates is there's an inversion of the yield, and that is not good for banks. Banks like to borrow short term and then lend long term. So they would borrow a short amount of money for a short amount of time, and then they might loan it to someone for a mortgage, for instance, and they take the spread between the two, and they don't make as much money when the yield curve is inverted. So we have to keep an eye on that, and that's usually an indication when its yield curve is inverted. That means a very good chance of recessions. So everything that's going up and down today is recession-friendly stocks. So recession-friendly stocks are companies that pay dividends, that have low price-to-earnings ratio. Let's look at some of these. Growth stocks with low valuations, stocks that work well in both environments and are close to their historical average price-to-earnings ratios. Okay, we like to look at what could make the stock market go up and go down, and this is a good checklist. Things that happened this week. The European Union is basically saying Russia is a sponsor of terrorism, and that could help a war crimes trial, and it could help help kind of resolve that issue in the war. The other thing is China is actually putting some comments out that says that nuclear war is not an option, and it's trying to talk Russia into not having a war. The other thing is supply chain bottlenecks is almost resolved. There is no port imbalance for the ports in the West Coast. That's all resolved. The supply chain seems normal now. Let me see. Now we have a divided government. So when there was an election 2 weeks ago, and it seems like there's an equal balance for Republicans and Democrats. So that means that no major bills will be passed, and that's good. No news is good news. So there's no new laws that companies have to deal with. Usually that's what it means. And China's COVID situation is evolving into a crisis. So basically China is locking down. There's more and more indications that the COVID outbreak is out of control. So Apple is having a problem there where their main plant has these people that can't get out. They're trying to get out of work, and they're forced to stay there, and they're like fights and everything over there. So it is getting into a really bad crisis for Apple. But that's their main plant. They've shifted some of their operations to India, so that could help alleviate the problem with creating these iPhones. Another good thing that's happening this week is U.S. dollar is weakening. It's down 4% in the last week. So the DXY is the dollar index. It is a ETF that basically tracks the U.S. dollar to a bunch of other currencies. And so whenever the dollar goes down, let's say 4%, and let's say a stock like Google does half of their business overseas, that means their earnings will be at least 2% better for their overseas sales, because half of their sales times 4% divided by 2, that's like 2% better. So you can see how in just 1 week that'll improve earnings for Google by like 2%. If they have 50% of their sales overseas. All right, so and we're currently overbought. So there's a very good chance that we're going to consolidate unless we keep riding, the seasonality to the end of the year. We don't know. Right. So let's look at some of the variables in the stock market. The crude oil is up 2.5%. We've been saying since $100 a barrel, if there's a recession, the price of oil goes down. And we were guessing when it was up at 100, we were guessing it'd be around $70 a share. And, it's getting towards that. And that's because there's a lack of demand in a recessionary environment. Factories going, less trucks, moving things around. So when demand goes down, the price of oil goes down. And another thing that's hard to predict for oil is you don't know how much supply is going to be taken off the market. And OPEC basically controls the supply, a good portion of the supply. So even in our best guesses, we still have absolutely zero control over geopolitical events or understanding the price of oil. We just have these understandings. If the price of oil goes down, it's a very good indication that the global economy is going into a recessionary or lower economic activity environment. All right, so 10-year Treasury unchanged, 2-year Treasury unchanged. We know when a 10-year or 2-year goes up, it's bad for tech stocks, and when it goes down, it's good for the stock market. And there's no changes in inflation. It's around 7.7%. Like I said, the U.S. dollar index is down 4%. All right, so let's look at what's going on in the sectors. Probably the drugs, and I didn't even look at it yet today. I think the drug stocks, all the conservative stocks are probably doing good today. Banking is doing good. Real estate, healthcare, there it is right there. Healthcare, dividends, paying utilities, telecom. These are all stocks with high dividends. Banks have high dividends. Industrial, financial, biotech. One's doing the worst. Gold miners, semiconductors, oil, gold, mining, energy select. Okay. So the price of oil, so commodities, this has probably a lot to do with the dollar too, because the dollar, whatever the DXY, let's see, DXY chart. Commodities follow the dollar because all commodities are priced in dollar terms. So you can see the dollar is basically been going down recently. Let's look at the year to date. There it is, year to date. It's going up for the longest time. Now it's starting a downward trend. And that affects a lot of the commodity-based commodities that are priced in dollars. Okay, so that was interesting to go through that. Okay, we already mentioned that we have these these miniature uptrends going up to a channel where it's the absolute top today. Okay. And you see, the DXY, we were just talking about this. It was in an uptrend for a really long time, and now we're starting a new path downward. And the reason why we're following this is really good for the multinational companies. And if we have this trend where the dollar is going down against all major currencies, this will really improve the results of tech stocks, multinationals, a lot of companies doing overseas business. So that's really something we're going to keep our eye on and see if it continues in this channel. Almost every sector we're following has a channel. Treasuries have the same kind of chart. Stocks, indexes. So hopefully that goes down. The more it goes down, the better it is for earnings. For the S&P even. Fear greed index. We are greedier than we were last week. You can see last week we were like right here. Now we're greedier. There's complacency in the market now. And people think we're going to newer highs. And you can see that the VIX is down 14%. Last week it was 23. Now it's 20. And you can see we're also breaking out of this upward channel in the VIX. So it seems like market participants, the smart ones, the ones that buy options and etc., they are getting less fearful. And we expect normally, normal charts to go in this upward zigzag chain. So we're seeing a lot of indications that we're breaking out of our normal channels. And if this starts going into a downtrend, I mean, we had that same thing happen right here, but if this happens in enough of the charts, we're going to have a break in trend. So it's an interesting. I was listening to a podcast from CNBC, and this guy named Steve Kovac, I hope I got his name right, he was talking about the 4 elements to his sell discipline. Sell discipline is, you own a stock, you own the stock, you have to make 2 decisions, as an owner of a stock: when to buy, what price to buy, when to sell, and what price to sell. And that's 4 decisions, really. But these are some of the reasons he sells his stock positions. One is price, so concentration. So if a position gets too big, out of whack, or too big of a percent of our portfolio, that's one reason. Another reason is to a change in fundamentals, change in thesis, and a disingenuous management. And what he did was he went through each of these the sell disciplines, and applied it to a stock he just sold. He sold Facebook. And so he gave these 4 examples of, why he sold his Facebook position. And number 1, disingenuous, I had to look that up. It says, not candid or sincere, by pretending that one knows less about something than one really does. So let's say that guy that ran the FTX was very disingenuous. He was pretending that he was running a valid exchange, and then he was not. And so he was saying that Facebook has an arrogant CEO that's not responsible. And he's his spend is no longer reliable. So let's think of the other spends that Mark Zuckerberg made. He bought Instagram, which was a runaway hit. WhatsApp was very successful. He hasn't really monetized a whole lot of that yet, but his past purchases and investments were very reliably geared towards advertising revenue. And now, all their profits now, instead of going back to that ad, what they're really good at, he's spending all the profits and leading to losses. And that's called a change in fundamentals. So they used to be super profitable, and now they're channeling all their profits into this unproven business model. The third is they're not focusing on their ad business at all. It's a change in thesis. So the thesis before, as we were talking about, is they're the largest social networking company in the world. How many billion users? And they have the ability. They used to have the ability to target advertising to specific tastes because of their knowledge of all the people. Now they can't do that using apps because of Apple's business model. So they're trying to move, they're from this, it's a change of thesis. They're trying to move from advertising to, in social networking, to advertising in an unproven business model, the metaverse. So he says Facebook is focusing too much money and attention to video game nonsense. That was pretty funny. So this is an example. So now, if you own something and you're thinking about selling it, you have to go through this checklist and say, is the reason I'm selling this because the price of the stock is going down and I don't want to lose more, which is a normal investor way of looking at things, or has any of these four sell disciplines changed in my outlook in the company? So I thought that was an interesting exercise to go through. All right.
I think that's one of the stocks which is very, it's just hard to make a decision on it.
It's, the problem, let's look at it just for fun, just because it's a complicated...
and so in my case, I'll tell you my story. I bought it at a good, at a higher rate, and now I'm like, what do I do? The price has just gone down the drains. They are not doing well, but again, it's almost like, wait. I mean,
You know all the stocks we're following right now, like the electric vehicle charging companies and the startup companies that make electric cars, they're not making money now. It's like a pipe dream.
mm-hmm. Yeah.
Investing in Facebook is turning from a very reliable blue chip company that was predictable
Right.
to investing in this electrical vehicle charging network that might or might not work, right?
Right.
So that's why the stock is going down. And let's look at the earnings to see if we can make any sense out of this. Let's see. Meta. And we'll look at the current valuations for this. So let's see. Statistics. Okay. So wow, the PEG ratio after falling this much is 2.43. So the forward PE, Yahoo Finance thinks it's only growing at like 6% right now. Their numbers here, they're decent. The return on equity used to be like 60 or 80, and now that they're investing all their profits, they're not really as profitable as they used to be. They're not. So there's a big cut in a lot of these numbers compared to what we were looking at before. Let's look at. That's not it. Here it is. Let's look at the earnings estimates and see if we can make any sense out of this. All right. Earnings. Okay, wow. Look at that. In the last 2 weeks or so, let's look at the earnings estimates have gone down. I guess this might be because people are thinking they're going to keep investing unchecked into the metaverse. And if that happens, they're not going to have profits for a couple years later. So let's look at 13.77 divided by 9.09. Okay, that's 46% reduction since 2001 to this year. So 9.09 divided by 7.81. That's 15% less earnings next year versus this year. And then after that, in 2023 to 24, 7.81 divided by 10.19. Then they're going to grow 25%, and 9 divided by 1, and 15%. So they're trading at a PE of 13 now. Their promise that they'd be growing starting next year to the year after. So from this year to this time next year, they're going to be losing like 20%. Yeah. And then growing in 2020 after that. That is a big change from the big straight line we had before. So now what this means is from now until next year at this time, this stock is pretty much dead money, it's called.
Right.
It's you're trading for a stock that will in 2 years be growing at 15% consistently. Is that worth holding on to now? And there's something also called a lost opportunity cost. So if you could get a dividend stock that pays 5% or 3 to 5%, and it grows 1% or something like that, then you can consistently earn like 3 to 5% somewhere else while you are basically waiting for 2 years for this to go back to its 15% growth rate.
I agree. Yeah.
So
I think it's that investment.
Yeah, it's turning out to be. So we have to look at, for each of these rules for sell discipline, price concentration. For me, it's a really small. It's like 0.5% of my portfolio. If you're buying a lottery ticket, you put $10 into it, and hopefully that is less than like 0.10%, or less than a 1% of that's like a lottery ticket. You know what I mean?
Yeah.
So for me, would you be better off putting that lottery ticket into a electric vehicle manufacturer, or some other company that has a it's all. Let's look at that price concentration. For me, the price concentration is so low right now, it's not really an issue. Let's say change in fundamentals. Whenever I looked at that screen, are the main reasons we had this stock before. If we go back to what we had, the operating margin was like 60%, or more. It was like 80 or 100%, and the PE. The PEG ratio was around 1%. Now they think it's only growing at 6%, Yahoo Finance, or 5%. And let me see. So it's not the reliable, consistent growth stock that we had in the past. And when we look at something like, let's see, I like to look at Google. Only just to contrast against, unreliable companies. It's been very consistent over the years, and holding up their margins. Their margins are return on equity around 30%, and their PEG ratio is around 1. They're growing. Its PE is 18, and they're growing around 13. We know, and so that's. And they don't have that same dip. Let's look at Google just for fun. Even with Google stock down to where we're at right now, it's still growing like 10-15% a year going forward, because they have a pretty consistent business model. And they basically have like probably an illegal way of dealing with Apple, where they have ads on all iPhones, and no one else can get the ads on the iPhones, and they have their monopoly in Android and everything else. So they might get regulated, which might make these go down, but it's a little more secure of a business model. So while we're waiting 2 years for Facebook to get their act together, is it worth it? Do you lose that maybe 10 or 8% in a more reliable stock? I don't know. That's yep. I guess back when we were looking at this before, Mark Zuckerberg made so many really good decisions in the past about using capital.
Exactly. I mean,
and it was.
Yeah. You kind of trust, right? And you're kind of holding on to it for that reason. But as time goes by, when you don't see that change, you're like, something is not right with their strategy. What are they doing? Yeah. I agree with those 4 points that that you mentioned about the other screen.
Mm-hmm. Oh yeah, let's go back.
And I think they totally relate to what is happening with Facebook right now.
The one thing we don't know about, I could really see something like this taking off, an augmented reality headset, where you walk around and you just see stuff as you're walking around. Mm-hmm. If it's something that doesn't make you look like a weird virtual reality guy walking around and can't see where he's going. If you can like put it on your glasses or sunglasses, or that they have versions of this out there, but if you really do that right and it becomes mainstream, like phones, mm-hmm. and you can advertise and you can see if you're walking down the street and you see, oh, ice cream, half off, I'm there. That's the reason I want someone to make that. I want someone to be mainstream. Like, I think Apple's doing that. That's the reason I like Apple so much. I know they're doing an augmented reality. Mm-hmm. And I know Google's doing something like that. And it's just, I want to be in that really bad, because I can see the potential in that. Just think if they get something that works and it's usable. Right now, the biggest problem with the metaverse for Mark Zuckerberg, people say it looks like a cartoon. People don't even have legs in there yet. Yeah. And it's very unprofessional. Who's going to want to stick a helmet thing on your head while you're walking around? It's pretty uncool to me. But so that's why. But what they're doing, what Facebook is doing right now, they're making their own operating system. They've been muscled out of the iPhone. Google and Apple are controlling the iPhone right now for ads. And because they can't say certain things about every user anymore, they wanted to make their own operating system that only they have control over. And that's what this whole thing was about. That's why he's jumping into this. He doesn't like being bullied around by Apple and Google. And it's that one thing we were talking about. Is it going to be usable? Is it going to be accepted as a next version of the internet? I don't think you're going to see old people with this virtual reality headset on. I don't know. It's a lot like the electric vehicle makers. It's a crapshoot right now.
Yeah.
If he throws all of his money and changes the name and everything all in for something that doesn't. That reminds me of Google Glass. Do you remember that?
Yes.
It was like the best thing at the time. I was ready to pay $4,000 for this thing because I thought it was the next thing, right?
Yes.
It ended up being this thing. People just, they were freaked out when people walked in the bathroom with this thing on.
Yes. I remember that.
And so that ended up being, it's very similar to this metaverse and what they're doing there. And it could very much just end up like the Google Glass.
Yeah.
I don't know. So it's like it's turning into a risky bet. So now what they need to do now is they need to put some resources around the ad business and try to prop that up and get that back to where it was before.
Yes, agreed.
One thing I don't understand. I'm sorry, go ahead.
No, I still feel people are losing trust. So I don't know.
Yeah.
I am almost there, like ready to sell. It's just that I want to make sure, when I claim my losses, that's, my earnings are, because I do have some dividend stock. So then, how you balance that out. So either this year or early next year, I want to get rid of it because I'm very close to thinking this isn't going nowhere, this stock.
Yeah. So that brings me to this little point here. The end of year investing checklist. This might be obvious, but I'm saying it just in case someone doesn't know about it. Yeah, at the end of the year, last month of the year, you want to look at your, how much you've made, try to match up your earnings, your wages, and your dividends, and come up with your total income. And then try to match yourself up in, these different tax brackets, which are the next year's tax brackets. Say, what I did was I made a quick example, of a bracket we're trying to target, 22. As you can see, the difference between a 12% tax bracket and a 22% bracket, it's a lot. So if you could somehow come out with your tax statement on your W-2 as earning $44,000, you'll earn a lot less in taxes. I mean, you'll pay a lot less in taxes, 10% less. So what I did is I put together a couple scenarios just for kicks, just to show you what you can do towards the end of the year for tax bracket planning. Let's see, hold on for a second. Yeah, let's look at Forbes. This is a good one. Okay, I think everyone's familiar with tax brackets. You could be either, for simplicity, it's a single filers. You can be a married filing separately, married filing together. For this example, we're just going to look at the single filer tax brackets. So basically, if you earn between these ranges, you pay 22% of taxes. So 89,000 times 0.22 is basically how much you pay in tax. So what I did was I'm doing a single example. Say if you earn 100,000 a year, you have dividends of 2,000, total income is 102,000. So you're going to be in this 24% tax bracket. So you try to figure, well, how do you get that? How do you get into the lower tax bracket? And the way to do that, you could do annual contributions. You can contribute to your IRA through work, and you can contribute, it's like 18 or 20,000 just by contributing that at work. But you got to do it over time. You can't just do it at one time. But let's say if you contribute, if you're at this time of the year, you can actually contribute like $7,500, $6,500 to $7,500. If you're over 50, you're allowed more, to an IRA, your individual retirement account. And what that does is that takes off the amount that you pay on your taxes. So if you have $100,000 in wages plus dividends, minus if you're able to put $7,500 into your IRA, then you end up in a lower tax bracket, like at $92,000, which is in the 22% bracket. So that's an example of end of year. You can actually you can do this tax maneuver of putting money into a IRA until tax day. So, but it's at the end of the year that you can also do tax loss harvesting. So, for instance, tax loss harvesting is whenever you're trying to balance out some of the buys and sells. So if you made some money in the year and you don't want to pay capital gains on that, then you sell some of your losers. And as an example, if your wages are 97,000, stock gains 5,000, and your stock losses, if you want to sell some stock, let's say you sell 16,000 in losses. Then you end up in a 24% bracket because 22% bracket because you ended up, you can only take 3,000 out a year for your losses after you balance your gains and your losses. So in other words, you get 5,000 gains, 5,000 losses. Then you have 9,000, you have 11,000 remaining. You can only take 3,000 of that for losses from this year, and then you carry over 8,000 for the next year. And that's just a good way to avoid paying capital gains tax. Another good thing to do is if you're at a lower, let's say if you make 80,000 a year, and you know you have until 95,000 where you're paying 22%. You could convert some of your IRA, which is your 401k, or your individual retirement account to a Roth. We talked about Roth before. It's a way to prepay your taxes so you don't pay taxes on when you're taking your money out at retirement. So if you want to convert, you can actually convert up to $13,000 until you get to this $95,000 limit. So that's one good way to dollar cost to put some of your 401k into a Roth. And I know in our internal 401k for a company, you can actually do a conversion in plan. So if you already, for this year, if you already put it towards the pre-tax portion, and at the end of the year you say, oh, I want to move some of that to Roth, you can actually do that in plan. So our company allows that. So I've done that a couple times. So that allows you to actually come out of, I think they might have limitations on how much you're allowed, but you can actually have a portion of your 401k here at work in Roth and portion in 401k, portion of your retirement account in Roth.
So when you move to Roth, you still pay tax right now, right?
Yes. Yes, that's why I was saying if you make 80,000 and you convert 13,000 into a Roth, right? You got to pay taxes on a combined 93,000, right? So your tax rate, if you pay more taxes this year, but at least you can convert whatever you want as long as you stay within that tax bracket.
Right.
That's a good, if you want to do it. A good one time I did this in a major way. I rolled over accounts, like all of my accounts, right whenever COVID was crashing, because they were already invested anyways. So whenever they were basically half the value that they used to be, I figured I'm not going to take the money out and reinvest it. I'm just going to I'm going to move it from regular to Roth, when the market's low, and that was a way for me to do this Roth conversion at half the price as normal. If the stock market crashes, you could, or it goes down like it did this year at 30%. You could put pieces if you already have it invested anyways. It costs you less if you dollar cost, into putting some into a Roth as it goes down. Does that make sense?
So how does your value remain? I mean, it's still the stock price is going down or the bond price is going down, wherever you're invested in. Even if you put it in a Roth, it's still going to go down.
Well, the theory is, let's look at that example in the S&P. Okay, let's look at the maximum for the S&P, right? Okay, let's say we have a situation, and we could go to this crash again. This was in 2020. Yeah, this was the COVID crash. The theory is that we're going up in a straight line, right? We're growing at 7% a year, right? Over time. If you're 100% invested, and we correct down to here, let's say, this is 191. The value of your 401k up here was like let's say 100,000 for even numbers. If it corrects to COVID again, that's like, it's worth 50,000 at that time. But the long-term value, or if it goes down, the long-term value of your, of your retirement account is probably in the middle here. If you go in this middle line, that's like the overall projection of the S&P 500 is 8% a year. And if you could somehow convert, the value at 50,000, let's say at a tax bracket of 22%, 50,000, you'd pay, for 100,000, that'd be $22,000 to do that conversion. You did it up here. But if you did the conversion down here, that will cost you 11,000. And the theory is the stocks are pretty much worth right in this median line, right? Because they're growing, the stocks in the S&P are growing around 6 to 8% over the next 100 years, let's say. And, if we get an opportunity to do that conversion, if we're in a stock market where it's dropping, if it drops back down to here again, the long-term line for the stock market is like 8%, like a PE of 8 to 10. And if we can get a conversion done at half the cost, and that'll allow us to avoid that problem of paying taxes whenever you're older. And that's a huge benefit, because we're going to have millions whenever we're retired, and it's just not going to be like we're going to pay $20 more a year. We're gonna have like $100,000 bills when we take out this money. That's the way I'm thinking about it. So the sooner we do that, because we did this calculation before. Let's look at that Roth calculation we did. Hopefully I separated that. Did I? Roth versus 401k. This is whenever we had this starting investment. We started with less because we did a conversion right away, right? So this is an example of 100,000. We converted. We had to pay 25% taxes right away. This is the Roth, and this is the regular. So it looks like a good deal for the regular until you get to retirement time. Let's say, look, you started with less, same amount, 8%. But once you get to this point right here, which is when you're 71, you start exponentially. This is when you start withdrawing. The amount you keep, taxes paid. Then you start paying taxes on this, millions of dollars. And then you start paying $21,000, $23,000. You're forced to take the money out in a normal 401k. But the way 401ks work, from the year 72 to your projected life expectancy, 90, you take out, it divides those years into like the number of years by 20. Number of years from 9 to 72, then you just take 2%, 4% out this year, 5% out this year, 6%. It's all in a table. And you're forced to take that out so it doesn't compound after this year. So up until when you retire, it looks great. But after that, you're forced to take it out. This gets less, and right here, that's the break even, right around 78. And then, let's take it back down to like 90, you're forced to take all your money out. So you have zero whenever you're 115. So you have $48 million whenever you're 150. So, but that's starting with 100,000 and you live to 150. But you get the idea?
Yeah.
Your estimated the goal of the government is to force you to take money out until your life expectancy, which is like 95-ish, right?
Right.
So you should have $0 when you're 95 with your expected life. But in the Roth, you can like keep it and keep compounding, and you're not forced to sell, and you're still growing. So that's the big difference.
Right. That makes sense now.
Yeah. So, but if you can take, I'll send this chart out. But if you just take a small amount, then just for your own calculations, just $3,000 today, let's say, and you can see that, and you still have your 100,000 in that, and you can do your own calculations and say, well, maybe next year I'll add contributions 4,000. Every year you just do a little bit more, right? Mm-hmm. And then withdrawals, you take maybe 4,000 out of that one. You can see how over time, if you dollar cost into that solution, it won't hurt as much, especially if you keep within that tax bracket. Then you're starting to build like maybe an alternative, solution. Whenever you get to 70, you at least still have maybe half of your money, tax free. Half you have to start taking taxes out of.
Yeah.
So anyway,
that makes sense. That's great information. Thanks, Greg.
Oh, right. I'll send this table over.
I was thinking about this. Yeah, please share this.
Yeah. So I actually, I put everything in the Roth. I spit the bullet right when it was like the COVID lows. I said, I'm going to start putting it in. I convert all my 401ks, and only because I saw this chart, and I'm like, but it was kind of, my decision was kind of irrational at the time. I was doing the calculations, but it could have went down more, and I shouldn't have put it all in once. I was kind of lucky, but I guess if I was doing it again, I would put the chunk in, but I wouldn't. I would just hope it goes down more and put a little bit more in at a time. The only problem is some plans only allow 2 or 3. Like our plan at work, you can only do that conversion in plan 2 times a year. You can't dollar cost into it. You can't put 3,000 this month, and so anyway, that's
you have to make that decision just 2 times, and that's whatever you decide. Yeah.
But we don't know. We don't know. There's a lot of people saying that we're going to go down in another COVID crash. We can't predict that, but we got to have a game plan of things you could do if that happened. And it's not all the stocks will be worth this amount whenever they go down there, but if it does go down, are we ready to start converting some of the 401k to Roth or whatever? And I don't know. That's just an idea. It's not something it's a popular thing for people to do because it takes away from your money today. You pay more taxes now, and that's pretty uncool sometimes. All right. So that's a very good, interesting idea. All right. Well, I think I've over-exceeded my time. Thank you very much for attending. That was a good question. I like that. And have a good weekend. Have a good rest of your Thanksgiving.